I don't know what next year's going to bring, Patrick. We got another election here in the U.S. It's going to get crazy. You know, you thought 2020 was crazy. Next year is going to be wildly unpredictable and volatile.
Please join us for our next live stream Sunday, December 19th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, December 19th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television SBTV. I'm your host, Patrick Vieira. As always, if you're new to our channel or if you haven't already done so, please do subscribe, hit that bell to be notified of new updates, and give us a thumbs up. They really do help us out a lot, and we appreciate them greatly. Craig Hemke, a.k.a. Turd Ferguson, joins us today. Craig was a licensed security professional for nearly 20 years. Disgruntled by the fraud known as financial services, he retired to a career as a serial entrepreneur in 2008. Though otherworldly in his ability to forecast price movements, the Turd is not a soothsayer, psychic, or a witch. After all these years, he simply has a decent understanding of the forces at play in the precious metals market. And we are delighted to have Craig Hemke return to us once again today. It's time to saddle up and silver up for Craig Hemke. Craig, welcome back to SBTV. How are you doing?
Patrick, my old man, good to see you, buddy.
Great to see you also. Thanks for giving us some time today. You look good. You look good out there. Craig, we are about to bid goodbye to 2021 and welcome in 2022. The gold and silver prices have been sideways pretty much for the entire year. What do you make of this more than year-long consolidation?
It's excruciating, isn't it? I mean, I just celebrated. There's a good word. 11 years of TFMetals Report, right? So it was a lot of fun first couple of years. And then 2012, QE3 gets announced, about the fall of 2012. We thought, okay, here we go. It's $1 trillion of QE. And the problem was that the other central banks around the world were printing even faster than the Fed. So relative to the other fiat, the dollar got stronger. Yeah. And so in April of 2013, as everybody knows, the long-term floors, that had been in place for about a year and a half were taken out and the prices plunged. And we wandered in the desert for about 5 or 6 years, right? I mean, I'm like Moses holding my arms up. And anyway, that was brutal. Right? That was no fun. This has been more brutal and less fun because at least in 13 to 18, you felt like, okay, the Fed's doing their thing. They're trying to pretend that they can hike rates and all this kind of crap. You knew eventually that was going to end, and it did. But this time, 3 years ago, stock market started to crash. 10-year note got above 3%. Everything changed, and we've been rallying since. So at least you felt like, okay, there was logic. But at least you can understand why, prices were doing what they're doing. What's brutal about this year is all of the macro stuff that I began the year with, forecasting, stagflation, surging inflation, none of this transitory crap. Fed not being able to allow rates to go up, so sharply negative real yields. All of that stuff, Patrick, has been right. Yeah, and nonetheless, price goes nowhere. Team transitory has been in charge the whole time. Yeah, real yields might be negative 5%. No, that's okay. Eventually rates are going to go back up and inflation is going to come down. So, and that we even had a period, within the last month where it looked like we were finally shaking that off and then slammo, we go back down. So it's been a very difficult year. Next year, well, maybe we can talk about that. Next year, man, just for a whole number of reasons, I think is going to be wildly unpredictable and volatile.
You spoke in a recent podcast about massive red candles, and it's not massive enough until you actually see it on that chart. Yeah. Massive red candles in gold that has appeared from time to time. And the most recent occurrence was last week where prices went down and touched the 50 and 200-day moving averages. What do you make of that price action?
Well, I don't know what you make of it, Patrick, or what your readers make of it, but I know what I make of it. It's massive bank manipulation. They lean on the price to get price to plunge through moving averages, as you said, or other key technical support levels. The speculators that maybe had bought gold futures then all head to the exits because they're getting buried with margin calls. The banks never get buried with margin calls because they're too big to fail. They got infinitely deep pockets. They can lay on fresh shorts like they did within the past month, where open interest in COMEX gold went up by 20%. 112,000 contracts. I mean, that's like 300 some odd metric tons of gold that was created from nothing. The banks offer those contracts onto the COMEX. The speculators buy them. It dilutes the supply, soaks up the demand. And instead of a $200 or $300 rally, you get a $50, $80 rally. And then eventually you tip it back over because the speculator demand is soaked up. And then all of a sudden, everybody that bought at 1850 and 60s underwater, they're getting margin calls or coming up at the end of the month, the December contract's going off the board, and blammo, the bottom drops out again. The result in keeping this downtrend going, and anybody can see it on the chart, right? I mean, just consecutive lower highs and lower lows until we had this most recent one, but now we're going down again. You keep sentiment down, you keep price tailing off, you keep your long established short positions that the bullion banks have, at least not, from going deeply underwater. And how do you do that? Through these massive red candles. You can go back to the first of the year, Patrick. There's now, it depends on how how do you view massive? $25, $30, 1.5% move in a day. There's 30 of them. 30 days. There are 20 to 22 business days in a month. So we now have a month and a half. Think of that. Think if they all happened in a row. If you had 30, I mean, hell, silver's been down 11 days in a row as we talk about this, so whatever. But it has the effect of these massive red candles has just been terrible for sentiment and momentum. Because every time you think, okay, gold's finally going to do what we expected to do all year long, bam, here comes another couple massive red candles. But think of that. There have been at least 29 or 30, it depends, like I said, how you want to call it, of these massive red daily candles this year. And it has kept sentiment in the toilet. It has kept the trend going downward. And that's all part of what has made this such a frustrating year.
Yeah. Craig, with sentiment in the toilet, as you said, and the trend going down for gold, let me ask you there, which markets rallied? And if traders sold gold and silver, what were they buying?
Yeah, well, you look at the stock market. What's the stock market up year to date? 34%, yeah. Right? And Bitcoin's up 300% or whatever. And I don't have any doubt that's if there was no such thing as Bitcoin, the flows into precious metal would be even greater, right? But now people look at that and think, well, okay, this is at least an alternative investment. It's a speculative investment. There's still no doubt about that. But nonetheless, that's siphoning off dollars as well. And at the end of the day, Patrick, we live now, nobody has an attention span longer than about 10 minutes. I can sit here and lay out all of this bullish case about gold and the gold miners. I got this friend of mine I've made named Tavi Costa that works out in Denver at Crescat Capital. And he does all these great charts showing how the mining companies are cranking out free cash flow for the first time, like in history, it seems. Then you got all these great fundamentals. Nobody cares. Why? Well, why do I want to care about holding gold and maybe, in a really good year where the banks play defense, it goes up 20%, when I can just buy friggin' Tesla, or some other meme stock and make 20% in a day or a week? And so, so it's really hard to fight that prevailing sentiment. This notion that nobody needs diversification, nobody needs safety, nobody needs a balanced portfolio, man. Just plow it all into that Kathy Woods ARC fund, and let's make as much fiat as we can. That is still the prevailing sentiment, and that is something that, we just keep fighting. People are still stacking gold. A physical demand remains really strong, whether it's through central banks, whether it's, like the citizens of Turkey. I mean, as the lira has been devalued, look at how gold in Turkish lira has just been soaring. I mean, it's doing its job there. But, what we all care about is a dollar price, not the Turkish lira price. And for now, there's just not enough demand for all of it in all its forms, particularly in the futures contracts. It's in the futures markets that price is discovered, if you will.
Okay, Craig, you've also spoken about the possibility of these lower gold prices where if it breaks a few important trend lines, and if it does, how low of a gold price would you consider as your blood in the streets scenario?
Well, we started talking about this last week at my site. Once it was about 2 weeks ago that that we started getting kind of worried that everything was rolling over, and it was 2 weeks ago. We're recording this on the 3rd. It was 2 weeks ago today. That all of a sudden gold slumped from about 1860 down to 1850. The next following Monday is when Biden announced that Powell was going to be renominated, and that was, here comes another one of those massive red candles, right? So once it was pretty clear that this was not the breakout, you're looking for. We got above 1830, went to 1880. It was like, okay, if we now get above 1920, that didn't happen this time. Then you got to start worrying about how far can this be run to the downside. Then all of a sudden, here comes Omi, my homie, right? Omicron. And everybody's freaking out. Nobody knows anything about the severity of it yet. And frankly, if you study virology or, and the evolution of viruses, does the virus, not that viruses have brains, but as they evolve, they need a host. So typically viruses don't evolve into something more deadly, because if it kills off all the hosts, well, then the virus is done, right? So typically they evolve into, look at all the different variants of just regular cold viruses. That's why you don't have a cure for the common cold. Those are coronaviruses too. They typically evolve into something that spreads more, but is less deadly. But we don't know any of that yet, and everybody's freaking out. And so long answer to your short question, it was last Friday in my summary podcast for everybody. I do one every day at my site here. I mentioned, okay, what's our downside? Let's compare this to what we went through in February and March of last year before the Fed, opened the floodgates. And COMEX silver went down to like 12 or 13 bucks at the low in March of 2020. Again, like you could buy it that. I did. One of my companies I work with has a platform that you can kind of do that sort of thing, but you can't. Every place else, is $24, $21. Nobody could buy it at 12. Gold went to 1440. I think the day on March 20th, the Friday before QE to Infinity was announced, on the 23rd, it was 1480. All right, so is that what your downside is? If, we're heading into this fear and shutdown? I don't think so. I don't think that's what the lows are. So the levels I'm watching, first in gold, 1760 has been a real important level of support or resistance. Below there, though, there are a series, two different double bottoms on the chart, one from last year and one from this year. Actually, no, they're both from this year. Anyway, 1680 and then 1720. There's two kind of stair-step double bottoms. Below 1760, okay, well, then here comes 1720. And if it really gets out of hand, I think 1680 is your worst case. 1680 was base support level for a long time, April to June of last year. So I think that's your downside. If things really get wacky before the Fed reverses course. Silver, when it broke down through 22 for a day back at the end of September, if you look at the chart, there's the one last gap. A lot of people think anytime there's a gap in the chart, eventually it's going to get filled. The one last gap is down about 1950 to 20. Now, silver's already fallen 11 days in a row, and it's getting really, really oversold. So I don't know, absent some huge spike in the dollar, and all this other craziness, in a mini version of February, March of last year. I don't know if we can get all the way down there, but when we drop below 22 back in September, that's what I started thinking, is that you might get like a one-day plunge down below 20 just to fill that gap in the chart. That would be like, well, I don't want to make it sound like, this guy just says, oh, you got to buy the dip and all that stuff. But man, I can't. You get a dip down there. That would probably be, if you're aggressive trader or stacker, I would say that would be something you could use to your advantage.
Craig, U.S. job reports was just released. We gained less than half, some 210,000 of last month's 546,000. How do you read this report, and how does it impact your macro view of the economy?
Oh, brother Patrick, if you had people come on here and talk about the birth-death adjustment before, do you think your audience knows what that is?
Probably not. Well, the
Okay.
host doesn't.
All right.
So
The birth-death adjustment is a statistical adjustment that the Bureau of Labor Statistics applies every month. I mean, it's all guesswork, right? They do some surveys mid-month, they call up some folks, and then they just guess. Well, that can't give you an accurate number how can you possibly sample everybody during a 1 week period? I mean, it's ridiculous. So they've got all these statistical little models they use that are mainly based off of how, once they have the data from years past, that they say, okay, well, typically this is how things go in the month of August. So we're able to apply, some factors to that, some seasonality, and they think they're coming up with a more accurate guess. Okay? Because how can they possibly know? So it's all kind of statistical guesswork. Well, one of the big adjustments they have is called the birth-death adjustment. Now, if you've never heard of that, you might think birth-death, how many people are born versus how many people are dying. No, it's how many businesses are started, versus how many businesses go out of business. Okay? And then they have the typical average number of workers, that are gained or lost versus the typical number of businesses that are starting or going out of business. Okay, and they know this adjustment is based on however many decades, years worth of history, month by month. Okay, so back in October, the birth-death adjustment was 363,000 jobs. Okay, so if you take that off, then the October number was something like 170. I think one was like 531 was the reported number. I can't remember exactly what it was. Of that 500,000, 363,000 were just simply this guess. Well, in Octobers in the past, there have been the average number of businesses that have started. There's an average number that have closed. And so on average, that has added 363,000. So that's how many we're going to add this month. It has nothing to do with what's actually going on in October 2021. It's just a guess. That's all they can do. So we added 363,000 to the number last month, came up with this goosed 500,000. You know how many they added today by the birth-death adjustment? 12,000. 12. Okay. What was the reported number? 221 or 217?
Reported number was 210,000, I think.
Okay. So take those 12 off, and you've got a number that's pretty close to what last month was, right?
Yeah.
Without the birth-death adjustment. So you goose it with this statistical garbage. Hooray! Look at all the jobs. You don't boost it with the statistical garbage. Oh, look at how terrible this is. It's nonsense, man. Can I say bullshit? Is that okay?
Sure.
Okay, it's bullshit. It's ridiculous. Gives all the talking heads of the media something to talk about. The politicians go out, look at what a great job we're doing, when they have a massive number like that. And then you're not going to see Biden and the rest today going, oh, yeah, 200. It's just crap. It's just crap. But, the banks and the traders can use it to swing markets around with volatility and profit. That's maybe I was just talking to somebody, Pat. Maybe you can appreciate this. And I especially appreciate it as I get older. There's a very fine line between being a cynic and a realist.
Yeah.
I may have crossed it. I don't know. Well, everybody else decide, I guess.
Let me ask you then, how about the unemployment numbers? Unemployment of 4.2%.
Yeah.
Are they comparable to pre-COVID unemployment numbers, or are there a lot of asterisks that would need to be applied to the unemployment numbers today?
Can I make one with my fingers? An asterisk?
As long as it's not one finger.
You know that if you haven't found a job within 12 months, if you're unemployed and you haven't found a job within 12 months, they stop counting you. You don't even count anymore. You just drop off because the BLS assumes, well, you probably found work. No, no, especially not in these days, right? People are staying home. They got to care for their kids because the school's closed, and all this other crapola. They don't want to get the shot, so they have to get laid off from their jobs, all this stuff. So if you haven't found work within 12 months, if you had been unemployed and the unemployment rate was 6%, 12 months later, they don't count you in the pool anymore. So guess what, Patrick? The unemployment rate goes down because the denominator is smaller.
Okay, Craig, do these numbers change any of the plans for the December taper?
Yeah, good question. We're going to find out. It's going to be a really interesting week the next 2 weeks. And then, then we'll just take the rest of the year off and go get drunk, I think, Patrick, because it's been that kind of year, man. Next Friday, the 10th, we get the latest CPI, okay? It was the CPI on, I guess it was November the 10th. That came in, whoa, what's going on here? 6.2% or whatever. And, that's when gold really took off and made through 1836 and made that run up toward 1875 and 1880. Well, the next CPI is next Friday. So that's going to be interesting, right? Because even Powell and Mother Yellen herself were like, yeah, they can't use this transitory word anymore. And remember, the PPI is annualizing at 9%. So, and then we still have wage inflation, all this other jazz. So, hard to imagine the CPI is going to come in, like in a big drop off next Friday, but we'll have to wait and see. And then the following week, try to make sure I got what's the 14th and the 15th is that December FOMC, where, are we going to start doing, what are they doing now? 15 billion a month they're reducing. Are they going to ramp that up to 30 billion?
Yeah.
I don't know. I have no idea. They got to do, now the discussion is policy error, right? That the Fed, because they are so reactive, right? Yes. They move. Well, we got to see a, glacial pace. Remember, Patrick, they used to talk about changes to the Fed funds rate. You didn't even see an impact for 6 or 9 months. Yep. Remember, that's what they used to say. Okay. So now they're talking about, well, we might hike the Fed funds rate as soon as June. So that won't even really have an impact until early 2023. Well, God knows where we'd be by 2023, right? But all this is spun into some kind of news. You got to act on today. Got to rally the dollar and sell our gold futures, and it's all just, it's crazy. But it's going to be that Fed meeting in the middle of, the week after next is going to be obviously a big focus. And then in 2 weeks from today, will be the 17th. We'll be a week away from Christmas, and maybe, tax loss selling and the mining shares will be over. Maybe we can rally into the end of the year. But the next 10, 11 trading days are going to be volatile.
Craig, so how do you think the Fed can bring down inflation, or are we going to see a Volcker moment? Can they possibly do that?
Yeah, that's the corner they've painted themselves into. Yeah, again, another meme that we've had at TFMetals Report for years. I got a picture I used with some of my posts where it's some gal that's painted herself into the corner. Because that's exactly right. Again, we just spin this back 3 years ago. Okay, the Fed, for 5 years, spun this narrative that they were going to draw down their balance sheet, right? Yes, we are going to let bonds mature and the balance sheet's going to go back, normalize. Remember, normalize was a big word. Rates were going to normalize too. And I was like, wait, no, you can't. We're already paying $500 billion a year in interest on the national debt, right? It's $30 trillion in debt, paying $500 billion a year because they've been able to lower the total collective yield, the interest that they have to pay on that's like 1.6%. Okay, well, let's let rates go up to 3.2%. Now you're paying it more than $1 trillion a year. The whole thing just spirals that much faster out of control. So this notion that the Fed can ever normalize, they've got to keep everything. If you raise rates, that's disinflationary. That's soaking up money. The economy, to keep the plate spinning, they need as much cash as possible to keep servicing all of this existing debt. And to keep the wealth effect going, of keeping the stock market up, all this kind of stuff. And so we saw this in 2018. The whole thing finally came crashing down. The 10-year note got to 3.25%, and everything seized up. The stock market, the S&P fell 20% from late November to Christmas Day in 2018. They had a meeting of the President's Working Group on Capital Markets, the Plunge Protection Team, on Christmas Eve. Christmas Day, the markets are closed. December 26th, Dow magically goes back up 1,000 points. But that was the moment that the Fed then said, oh, we can't do this. By June of the next year, because it takes them a while, they actually started cutting. Real rates have been falling the entire time over the last 3 years. Nominal rates have fallen back, and obviously the COVID thing, drove it all the way back to 50 basis points or whatever on the 10-year note. But this idea that they're going to somehow withdraw liquidity, stop adding it, step away from the bond market, let the bond market soak it up. Well, maybe they've created so much reserves. What is it, 1.5 trillion in reverse repo every day?
Every day.
Maybe that will come flooding out to buy 10-year notes. Maybe for a while, maybe. But this notion that the Fed's going to control inflation by raising interest rates, again, with as long of a lead time as that takes, I mean, that's not going to happen. That's the jam that, if I was Powell and Biden said, hey, Jerry, thinking about going with this gal over here, Brainerd, I'd have gone, yes, scrap, dealt with this. I'm moving to Florida. I'm going to play golf every day. I don't want to do any part of this job for another 4 years. But, the fame and the having the microphone at CNBC and all these places whenever you want it, I guess, is too much. And so you want to stick on for another 4 years. It's a real jam that we're in. All the stuff they tried to do in the 80s, they can't do today. So we'll just, we ride it out. We buy the physical metal on the dips, knowing that it's our protection for when those plates all finally stop spinning again. And I don't know what next year's going to bring, Patrick. We got another election here in the U.S. It's going to get crazy. If you thought 2020 was crazy. Whew. So we'll just ride it out and understand what's going on. Like I said, all this statistical nonsense that they try to do. Understand the value of my precious metal doesn't change. The price changes in dollar terms, but the value of it, given all that we've talked about, it only goes up every day. So I'm going to keep buying it, and we'll just keep riding the storm out, my friend.
Absolutely. I'm entirely on board with you there. Craig Hemke, before we wrap up, can you let our listeners know how they can follow you on social media and about your services at the TFMetals Report?
There's my TFMetals Report. Yeah, TFMetalsReport.com. Post every morning telling you what's going on. A podcast every afternoon kind of summarizing things. I'm everybody's eyes and ears. So that you can go about your daily life. I'll sit here and torture myself and keep track of all this crap on a daily basis. So you know what's happening. Unfiltered and completely honest. It's a global community. I mean, one of the biggest values of the site is just everybody that's on there and the information that they all share and come up with. So please check us out. It's affordable. It's only $15 a month. And you can find all the details at TFMetalsReport.com.
All right, Craig Hemke, we thank you for the time. Go ahead and get yourself out on the golf course, and we wish you a very Merry Christmas.
You too, my friend. All the best to everybody on your end, too, and we'll talk again soon.
That was Craig Hemke from the TFMetals Report, sharing his views on the economy and precious metals. To learn more about Craig and his services, please visit www.tfmetalsreport.com. If you like this video, please subscribe, share, and give it a thumbs up. It really helps to support our channel. Audio-only versions of our interviews can be found on iTunes and Spotify.